So something that I noticed right after I posted the videos series where I was showing my M1 portfolio video on my what's actually inside of there, as well as the video before that where I talk about how I go about choosing the different stocks and everything. And something that kept kind of coming up on my my YouTube suggested videos was how to find PE ratios and using PE ratios to evaluate stocks and everything. I wanted to just hopefully really quickly touch on why I don't use PE ratio and why I think that's a really archaic and really kind of a useless metric. So in case you don't know, the PE ratio is what's called the price to earnings ratio. And essentially what it is it's a way of evaluating the price of a stock and comparing it to others to see whether or not you're getting a good deal or anything like that. So the analogy that I kind of think of is, imagine you're shopping for pickles and you go to the grocery store and there's a bunch of pickles on the shelf, and one jar of pickles is say $5.23 for a 24-ounce jar, and another jar of pickles is $4.50 for an 18-ounce jar. Now, which is the better deal? So the way you'd figure this out is you would just take the price and divide it by the weight. So for the $5.23 jar of pickles, that would be $0.218 per ounce. And for the $4.50 jar of pickles, that would be 25 cents per ounce. And then if you just kind of go with basically the rules, is you go with the cheaper one. So that would be the $0.218 per ounce. That would be the better deal, right? And generally the same rules apply when it comes to evaluating the PE ratio, or the price basically of a stock when compared to another one. The company that has the lower PE ratio in its stock is the company that you should generally invest in. Now, I say this with a major caveat, because when I first was learning about the PE ratio, and I kid you not, this is the way it was actually presented to me. It was basically said that in the absence of information, any other information about the company, you should go with the company that has the PE ratio that's smaller. The problem with this is exactly what I just said, is that in the absence of information. Well, in the absence of information, you shouldn't be investing at all. You need to be doing research into the company and know all that other information before you can even make any kind of a rational decision with what you want to invest in. Additionally, the PE ratio can also give some false positives as well as some false negatives. I mean, if it's high or if it's low, does that mean that's good, or is it bad? Should you keep going with it? Do you need to research it? What do you need to look up? And the thing is, you're going to actually have to go in there and look at the financials and look at the management and look at what actually is going on with this company. And by that time, when you actually look up all that information, the PE ratio's information that it's actually giving you is now useless. You don't need to know any of that number because you have all the relevant information you're going to ever need to decide whether you want to invest. The PE ratio, or literally the stock's price to its earnings per share, is information about the company's stock, not the company. And I'm investing in the company or the business, not the stock. And there's usually ranges of PE ratios and what's acceptable and what's not. Usually anything less than 10 is considered undervalued. The stock is considered undervalued. Anything between, say, 10 to 15 or 10 to 20 is considered normally valued. Anything like above 20 is usually overvalued. And then anything over 30 might be considered in a bubble. But again, this is completely subjective and arbitrary depending on the investor and what the investor feels is an appropriate value for the PE ratio. I'm going to go ahead and show you some actual examples of where the PE ratio can actually lead to some false information when it comes to evaluating things. So in my portfolio, what I'm going to do, I'm going to show you a couple of stocks. I have what's called Northwestern Corporation. This is a utilities company. They provide power, electricity, and gas to the northwestern side of the United States, like Washington and in that area. And if you look right over here, you can see you have their price and everything, but then over here, this is their price to earnings ratio, and right now it's at 17.37. Now, if I look at another company within the same sector, because you want to stay within the same sector, Avista is another one that I own. They also provide power, electricity, like around your Idaho, Oregon, again, kind of a similar region. But again, it's the same, they're a utilities company. Their PE ratio, you can see here, is 19.93. So that's not too bad, all right? They're kind of within the same area range-ish of a PE ratio. Now, here is PCE, or this is Pacific Gas and Electric, PG&E. They also provide electricity and power to, like, say, Northern California. But if you look at their PE ratio, they're at 4.16. But if you go with the basic rule, which is in the absence of all information, you're supposed to go with the cheapest or the smallest PE ratio because that's supposed to be the most affordable. Well, that would be PG&E. But let's have a look under the hood at these companies and see what's really going on, specifically when it comes to their revenues. Now with Northwestern Corp, you can see their revenues are not too bad. All right, I'm looking really at the pattern. And if I come down here and look at the net income, which is their revenues minus their expenses, that's not too bad either. It's pretty, I can work with this. Okay, it's pretty consistent. All right, no major dips or anything like that. If I look at Avista and I look at their revenues, again, still not too bad. It's not going to be, skyrocketing or anything. These are utilities companies. They're providing the same service for a bunch of customers. Their net income, same kind of story. It's pretty standard, pretty straightforward right across the board. I'm not seeing anything major spikes. I'm not seeing any major dips. But if I look at PG&E and see what they're doing, okay, their revenues, not too bad. They look pretty good. But if I come down here and look at their net income, you see a major problem. Okay, and in case you don't, you haven't seen this before, when you're looking at it like accounting spreadsheets like this, numbers in parentheses mean negative. So here they were at like 1.6 billion. This is in billions in net income, and then it went to negative, almost negative 7 billion within about a year. What the hell happened? And I don't need to know anything about a PE ratio to know that that's not a company I want to invest in. But yet, the general rules about a PE ratio are the one that's smaller is the one you want to go with. Likewise, let me show you another example of a company that also has a problem, and this is with Amazon. Now, Amazon, if we look at their financials, look at their total revenues, this is looking really nice. Good, solid growth. If I come down here to their net income, even better. Okay, this is Amazon we're talking about here. All right, so they're doing really well, and they look really nice from a financial standpoint. Now, they don't pay a dividend, but if I was evaluating this company based on their growth and their growth potential, and then I wanted to sell them later on for a profit, I could definitely see that being the case. But now let me go ahead and take a look at their actual PE ratio. And you'll see that it's at 118, which, if you remember, I said anything over 30 was basically considered in a bubble and way, way, way overvalued. So does this mean that Amazon is a bad pick because its PE ratio is so huge? I would say absolutely not. Now, Amazon is not in my M1 portfolio because it doesn't pay a dividend, but it is in my Roth IRA and my 401k because it's in mutual funds that I'm also invested in. And I'm glad that it's in there because I think it's a really great, solid company to be invested in for growth and growth potential. And if I was looking for growth companies and I put on a filter, says I don't want anything bigger than a PE ratio of 30, well, then Amazon's just not going to show up. And how many other Amazon-like companies are there going to be out there where, say, the PE ratio is completely out of whack, but they're still solid companies based off of the financial statements that they provide? I have not met one person or one investor that has ever attributed any long-term success of their portfolio to them picking stocks based off of the PE ratio. If it's a good company with good financials and good solid growth with solid leadership, it's going to be a good position for your portfolio and provide good performance for your portfolio regardless. The PE ratio is not going to add or subtract any of that value. This is just more of an impromptu video. I just wanted to kind of get out there and link it to the others that I had out there so that this way I can get that information out to you guys as soon as I could. Anyways, I will actually talk with you in a couple days. Have a great one.